recently, pricing power has been a bit reduced coming out of COVID, where we saw a real surge in demand and a surge in pricing. So the market now is absorbing that over the past couple of years. We suspect that you'll see that resume a healthy upward trajectory, not necessarily dramatic, but healthy over the next year or so.
Hi, everyone. I'm Miriam Gottfried, and this is WSJ's Take on the Week. This week, we have another batch of earnings coming up, and among them are some big travel and leisure companies like Marriott and Airbnb. Our guest today is somebody who has a lot of insight into that market. We have Eric Resnick, CEO of KSL Capital Partners, which is a private equity firm that invests in travel and leisure. Hi, Eric.
Hi, Miriam. Thanks for having me.
Thanks for being on. Can you give us a quick overview of your strategy and the kinds of assets you like to own?
As you said, we invest exclusively in travel and leisure. We've been doing so for, over 30 years at this point. We tend to focus on the mass affluent consumer. But our hotel investments, as an example, span select service hotels to some of the world's most exclusive ultra luxury resorts. But the way we look at travel and leisure, about half of it's hospitality investing. The other half is split up between various recreation, clubs, and real estate businesses. So think of that as golf courses, health clubs, ski resorts, restaurants, and the like. So we do so globally.
Within leisure, there's the divide between sort of the budget traveler and the luxury traveler and the people in between. And then there's also corporate travel. How are each of those segments doing right now, like in this environment?
If you look at corporate versus leisure travel, leisure travel definitely is kind of that's the anchor in the travel industry. Leisure travel tends to be very consistent. Corporate travel tends to be a bit more cyclical. And I think people sometimes overstate the cyclicality of the industry as a whole because of corporate travel. But importantly, on a global basis, corporate travel is about 20% of total travel demand. Now, what we're seeing now is that corporate travel actually is rebounding quite robustly this year. In fact, our corporate travel demand across our hotels is growing faster this year than our leisure demand. But that's the natural consequence of leisure travel that came back so robustly in 21 and 22 into 23, and corporate travel that really took until about 23 to really get going. So we're still recapturing some of that previous corporate travel demand. And I think that's why you've seen a bit of an acceleration there.
So as you look at companies like Marriott or Hilton Grand Vacations or Airbnb, which segments of the market do each of those target, and what will you be listening for on their earnings calls?
They're each a bit different. If you look at Marriott, they're of course very global. I think they're understanding what they're seeing by chain class. So what are they seeing for RevPAR, the unit of measure in our industry, revenue per available room? What are they seeing in the luxury sector versus what are they seeing in the select service sector? But what I'd be most looking for is what's the forward outlook? What are they seeing in advanced bookings for groups or otherwise across the system? What are they seeing in system-wide new hotel openings? And I suspect we'll see that there's quite a robust pipeline there. But in this environment, I'm a little bit more suspect as to how quickly those pipeline assets will turn into actual construction starts, just because of the availability of construction financing and construction costs right now.
Well, getting into construction costs, it seems like construction costs are really high right now. What does it take to construct a new hotel these days?
Unfortunately, I would say every aspect of constructing a new hotel is hard. So you start with, it's about finding land, buying land. It's about the underlying entitlements and getting approvals. And then it's about the actual construction, right? All of that before you actually talk about consumer absorption of the new hotel. And if you think about those three areas, they're all harder than they've probably ever been. Land is scarcer, land is more expensive, construction financing is more expensive, and approvals, generally speaking, from a regulatory perspective, have gotten harder, not easier. So understandably, communities are not always running towards wanting to build new hotels. But at the same time, there's increase in demand and prospects for increase in demand over time. And so you certainly do need some new supply to be able to accommodate that in many leisure markets around the world or urban markets.
But the difficulties that you're describing mean that revenue per available room is probably going to be higher because there aren't that many available rooms being built.
Yeah, fundamentally, if you look at the industry over a long time horizon, we've generally had supply growth of about 1.5% to 2% per year, compounded for decades. and demand growth of, say half a point to a point and a half ahead of that. Today, you see supply growth that's something that really, frankly, rounds to zero. Now, which is interesting because you've got these very large pipelines that the public hotel companies, the hotel brands have. And so, but they're spread out over a very large geographic area and a large existing room base. So when we look at the near term pipeline for supply, and you know where shovels are in the ground, we're expecting that to be somewhere between 0.5% per year as you look out over the next 3 and 4 years, which is where you have kind of the most clarity. And so that should mean that you're going to start to see a bit more pricing power in the industry. And I think accelerated RevPAR growth, because that's a tailwind. Recently, pricing power has been a bit reduced coming out of COVID, where we saw a real surge in demand and a surge in pricing. So the market now is absorbing that over the past couple of years. We suspect that you'll see that resume a healthy upward trajectory, not necessarily dramatic, but healthy over the next year or so.
You expect to see stronger demand outside the U.S., I believe. And why is that?
Well, I'd say this year specifically, what we've seen is stronger international demand than you have in the U.S. Hilton's earnings reiterated that. Our own data shows that. We're up about 7% or so in revenues this year in 2025. So I think that's happening for a couple of reasons. One is that there's still tremendous desirability for American travelers to go to places like Italy, France, Spain on summer holiday. Some of those international markets, frankly, are coming off of low bases of travel, so they're accelerating quite a bit. And in the U.S., you have some headwinds. I think the tariff announcements created uncertainty in the market, and that created some consumer hesitancy. We saw our booking volume going into the tariffs be about, give or take 9-10%. We saw that come down a few points with the tariffs, or a little bit more than that, and then rebound as we went through the summer. And consumers, I think, realized that, okay, the outcome of this is not going to be quite as impactful as perhaps people thought in April. So I think there's just some of that noise. You've seen a reduction in international travel to the U.S. It's not a huge number in this scale of the overall hospitality industry. It's kind of a single-digit percentage, but it's still marginally impactful, more impactful in places that tend to have more international demand, like the coasts.
Okay, Eric. So we talked about Marriott, but we haven't gotten into Hilton Grand Vacations and Airbnb. What do you see in those businesses?
Well, I think in contrast to Marriott, Hilton Grand Vacation and Airbnb are really primarily focused on the leisure consumer. And the leisure consumer, is the part of the market that we think has the best resiliency and the best long-term demand outlook. So certainly that doesn't speak to what will happen with earnings next week. I don't have a particular perspective on that, but I would be looking for the same type of information that we talked about for Marriott. What are they seeing in forward bookings? What was their RevPAR breakout between geographic segments and or kind of chain scale, if you will? It's a little different, but you still have higher end properties versus lower end properties for both Airbnb as well as for Hilton Grand Vacations. So ultimately, I think those businesses are positioned really well because they sit squarely at the intersection of where the consumer wants their travel experiences to be, which is high levels of experiential travel, multi-generational travel, and in some cases longer stays that are facilitated by more remote work, and people want perhaps larger accommodations for that. So whether it's a timeshare or a vacation rental, either way, they cater to that segment quite well.
They cater to your segment, right?
They cater to the mass affluent segment. Some cater more to, as we say, the more affluent side of mass affluent, and some cater a bit more to the mass side of mass affluent. But the nice thing about vacation club ownership, and we're in that business too, we own Holiday Inn Club Vacations. The nice part about that segment is that they provide an accessible price point for people to come in and access those types of properties in a wide variety of leisure-oriented markets. And so, we participate in that segment, and we think it's a really attractive one.
So can we go back and define what mass affluent means in the KSL definition?
Sure. I'd say we think of that as the top 10% or so of income earners. So think of that as six-figure household incomes, kind of mid $100,000 to $200,000 per year with a college degree. I mean, that would be your prototypical mass affluent consumer.
Consumer sentiment, held steady in October, but it's still near historic lows. We have high inflation and hiring has slowed. How does that pessimism translate into the travel industry, if at all?
Well, we survey consumers around the globe on their intentions to travel. And interestingly, In the next year, we asked the question of basically, what do you intend? Do you intend to spend more or less on travel over the course of the next year? And where does travel rank in your priorities of spending? And from India and China to the US, travel ranks number one in the consumer desirability in terms of where they want to spend money. And virtually all markets expect to spend more on travel. I don't mean because of prices, I mean because they want to do more of it in the coming year than they did the last year. So I don't think that broader consumer sentiment data, frankly, is what we're seeing in the travel industry in particular. If you think about it at its simplest, if people are stressed out, what do they want to do? They want to go on vacation. If people are really happy, what do they want to do? They want to celebrate. They want to go on vacation. So I think there's kind of a bit, not to be flip about it, but I think there's a bit of an innate desire for exploration and for connection. And travel provides that. Experiential travel provides that. And that's what we see.
What about the hesitancy of people to travel to the U.S.? Does that affect your business at all?
When we look at our trends this year, we're down in travel from Canada and from international markets a bit. We're up in our international businesses. But overall, when we look across our portfolio, we're up, give or take 8% in revenues for the year and about 15% in EBITDA. So we've had a very healthy year. And I suspect that, that's similar actually to our trends last year. And I suspect next year will actually be equal, if not better.
We're going to take a quick break, and when we come back, we'll have more with Eric Resnick from KSL Capital Partners. A number of the big hotel companies no longer own their own real estate, right? Mm-hmm. And that's affected their stock prices. There's been sort of a divergence in the ones that own real estate and the ones that don't own real estate. Can you talk a little bit about why that's happened and what you think about that divergence?
That divergence has happened over the last 30 years. Put aside performance for a second. I mean, the genesis of that was, operators and brand companies, have evolved to be loyalty businesses, distribution businesses, in addition to operators and brand businesses. And the real estate owning entities have bifurcated from that, the hotel REITs and so forth. What we see is there's a real benefit to us from, frankly, doing both. So we tend to be an owner-operator. We tend to operate our own hotels. We own those hotels typically, and we'll partner with the brands. We partner with many of the brands to provide distribution and branding services under typically a brand franchise arrangement. And so, for us, that allows us to get the best benefit of access to the brand when we're using the brand, but also be able to kind of align our interests between, owning the real estate and operating it. I think over time, the public markets have rewarded the brand companies in particular because they're capital light. They've got these large system pipelines that provide unit growth, and they've been, frankly, proliferating brands, right? There's so many more brands out there than there used to be. And they have found a way to tailor those brands to individual customer segments to basically meet the customer where they are. And I think that's been really successful. They've also evolved the brands to appeal to real estate owners who want to continue to operate the real estate, or to cater to real estate owners who say, I want to take a hands-off approach. Can you take this off my hands and manage it for me? And overlaying all of it, the brand companies, the hotel companies, have done a tremendous job building out their loyalty programs. So whether it's World of Hyatt or Marriott Bonvoy or Hilton Honors, I mean, they're incredible. They're incredible loyalty programs giving value to the customer. And so, virtually every brand, including the international ones, of course, Intercontinental and Accor, are doing the same thing, and that's been really positive for the brand. So I think that's helped fuel that. But fundamentally, there is a real value to owning real estate. It just, not every investor is looking to own the actual real estate, but it's lower risk, it's highly tax efficient, and for us, if you control the operations as well as owning the real estate, it allows you to generate excess cash flow from that real estate, we find, because of that controlling all the levers of value creation.
And if, as a public markets investor, I wanted to own the real estate, what's the best way to do that?
Well, the hotel REITs provide a great opportunity to do that. And there's a whole host of the hotel REITs. I certainly don't have favorites over others, but they have different strategies, and that's a great way to own hotel real estate. I think increasingly you're likely to see that there's private market ways for investors to play those markets as well.
So a lot of people say travel is cyclical, and you kind of got into this at the beginning of our conversation, but you disagree with that broad characterization. Can you talk a little bit more about why you disagree with that?
Well, I think we define cyclicality of travel because we think about that large hotel in an urban market where we tend to live, and we say, "Oh gosh, business travel that fills that hotel, 5 days a week or so." That travel goes away the second that a CEO of a business sends out that email that we all have versions of that says, "Hey, times are tight. Tighten your belt. Cut non-essential spending." And look, often business travel is the very epitome of non-essential spending. And doing things like this, right, video conferencing or Zoom or, et cetera, makes that easier to cancel that last minute business trip. But if you think about that as it pertains to leisure travel, it's just not the same, right? You don't take a Zoom vacation. I don't think we're doing that. We're not doing a virtual beach holiday.
That doesn't sound very fun.
No, it's not fun. And until a virtual holiday equals a real holiday, I think you're going to continue to see this trend where leisure travel is remarkably resilient.
How has social media affected the travel industry?
Social media has had a tremendous positive effect on the travel industry. If you look at your social media feed, it's far more about experiences than it is about material goods. And the number one experience that people think of that they post about, frankly, is travel, right? It's you having climbed that mountain. It's you, on the golf course. It's you in the park. It's you at the Louvre. It's you in New York City at the great restaurant, whatever it might be. It's not you going shopping at the mall. And that is both leading and a indicator of the trend that we've seen in favor of the experiential economy over the material goods economy that frankly started 60 years ago. And we've seen compound growth in travel of 7% for 60 years as a result. And I think social media only makes that growth more accelerated because you look at Instagram as an example, and what you're seeing are aspirational videos and photos, of what do I want to do and where do I want to go? And travel's at the epicenter of that. So whether it's Instagram or TikTok or whatever your preferred platform is, I think it's nothing but good for travel, and it's going to continue to be.
Thanks, Eric. We're going to take a quick break, and when we come back, we have one more question for Eric Resnick. Okay, Eric, in 30 seconds or less, is the rise of AI good or bad for the travel industry?
The rise of AI is nothing but good for the travel industry. AI is going to make it easier for us to plan our trips. And frankly, those travel providers who are most well suited to provide the experience you want are going to be the ones that are surfaced by AI as recommendations. So I think if you're a high quality travel operator, AI is nothing but good. I think, frankly, it'll allow you to connect directly to your customer more quickly. And anything that allows you to get to your customer directly, we think is a real positive.
So we aren't going to be taking AI vacations anytime soon?
I don't think so. We once did an advertising campaign that showed people in New York City with their feet in like a sand bucket, holding like a martini or a margarita in their hand with virtual goggles on. That was showing them on the beach. And I think we learned from that as cool as that was, it didn't substitute for having your feet in the sand, in Jamaica or Cancun or Cabo, right? It's just not the same thing. So I don't think the AI vacation is going to threaten us anytime soon.
Thank you so much, Eric. This conversation has made me realize I need to go on a vacation. I really appreciate you joining us.
I hope we can help provide that. So no, it's a pleasure being with you, Miriam. Thanks for the time.